Joining us right now to talk more about what they're seeing in the markets is Ironsides Macroeconomics Managing Partner and Director of Research, Barry Knapp. Barry, let's talk this through. First of all, do you think the market has priced in tariffs that actually take effect and stay in place, let's say, for at least a number of months?
First of all, I think there's more downside for sure. I think Tom's, it's funny, it's the second time I've gotten asked about Tom in the last week, actually. Really? But I think Tom's time frame is too short. I think that in
terms of the volatility?
In terms of the market bottoming right now, because we are going through a really complex transition from what Treasury Secretary Yellen called modern supply-side economics, which is industrial policy, government spending-driven growth, government wages, and employment growing 0.75% faster than the private sector, something that's only supposed to happen during recession, to trying to spur a rebound in business confidence and more capital spending. I mean, that was, to me, what was really shocking on Thursday was that GDP revision showed capital spending subtracting 0.5% from GDP when government spending was adding 0.5%. And the two categories which have just been absolute lower left to upper right for decades, software investment, R&D investment, intellectual property products, slowed to basically zero. So we've got to make that transition. And if you think about it from a timing perspective, you cut spending, there's an immediate impact on the economy, you slow government employment, and it takes 1 quarter to 3 quarters to get capital spending to kick in, which will lead to the healthy broadening out of earnings that everyone's been talking about for the better part of a year. So this is a difficult transition. So, a couple of weeks ago, after the reaction to Walmart earnings, and I was talking to my old colleague Michael Lasser you had on earlier in the lobby about it, that to me was a real sign that the market is very sensitized to weaker growth. And for me, the bigger problem is not our $1 trillion trade deficit, it's our $2 trillion budget deficit and trying to get that under control. So we're going to have a couple of quarters of significantly weaker growth. For the market to bottom, 4 or 5 months before we get the deceleration of growth process to unwind seems a little early for me.
Yeah, so it's kind of interesting. We were talking about it earlier this morning. The idea that animal spirits was all anybody was talking about in January, early February, that businesses were ready to put things to work because this was the most pro-business administration they'd ever seen.
Right.
I think talk around the tariffs has led to some uncertainty that makes businesses maybe pull in their horns a little bit.
Well, the way I monitor this and measure it is the regional Fed surveys that just got finished last month, all the February surveys from Kansas City, Richmond, Dallas, Empire State, the whole thing. We had this big surge in 6-month forward capital spending plans from November through January, and they retraced about half of the increase in February, right? So businesses are sort of saying, well, yeah, we want to put more to work. We want to hear certainty about tax policy. That's why the sequencing thing has always been an issue, too, right? If you hit them with the stick and tighter trade policy before you finalize the better tax policy, then that creates, I hate the word uncertainty. It's like someone coming on and saying the market's going to be volatile. Right. What does that mean? Is it going down or not? Right. But these capital spending plans took a hit. So it's certainly a valid point. And tariff and trade policy is undoubtedly the reason.
So what do you tell people to do right now? Should they invest in this market or not?
Well, so I think it's worth it. The growth scare, soft patching growth is worth at least 10%, probably 10 to 12, down 10 to 12, and with 10s below 4%. At that point, we are going to get the Fed to start cutting again. I'm in the camp they're going to cut a full % this year.
Even if inflation doesn't go along with their hopes?
The inflation is the first order effect. The second order effect is weaker growth. I mean, it's a change in relative prices. Inflation is always and everywhere a fiscal and monetary phenomenon. So we're going to cut government spending. That's what the Fed should be focused on, not trade policy, and not the first order inflation effect. So for me, they will be cutting again by May, which is one of the corrective mechanisms for all this. So I actually would disagree with what Mike said, not really disagree, but shade it such that if we do get a weak employment report, and Goolsbee described the labor market as stable full employment. totally disagree. It's unstable. We have churn, the turnover's collapsed, the demand is weak. If you look at the bottom quartile of workers, their wages are growing 0.4% slower than the top. That was 3.6% above in January of 2022. So you're crushing low-end wages, labor market's weak, we get a really weak number and a very violent sell-off. Maybe at that point you get the Fed to start pivoting back towards easier policy.
So are you happy or not, Knapp?
I'm happy because I live in Vail, Colorado.
No, I know, but are you happy that we're going through some of this reckoning?
I just think it was inevitable. It was absolutely inevitable.
And it will come out the other side.
We
better
need
off?
to transition this economy from government spending to really getting capital spending
going. We'll come out better on the other side?
100%.
Okay.
100%. That was totally unsustainable, and our bond market was on the verge of some big, big problems. Okay. And, you know, Besson's...
And you live in Vail, so, okay, so you are happy. All right.
Barry, thank you.
I'm always happy. Yeah. If I sounded angry, like,
no, you
my
don't.
Intended tone.
No, but you know, 10 to 12%, they're doing this bad stuff is happening, this, that.
But that
I needed some light at the end of the tunnel.
That would be a good window, right?
Okay.
Because we do need to get the Fed back easing. We've talked about this before. They absolutely crush small businesses, floating rate borrowers. Okay. You know, by not unwinding their balance sheet more aggressively and jacking short rates up, they cause a lot of pain for small businesses and people that live paycheck to paycheck. We need to sort that out.